Right, good morning, good afternoon. How's everyone doing? All okay? Am I on mute? Oh. Can you guys hear me? Oh, okay. All right, thank you for confirming. And I hope you're also able to see the document. Let's get through those issues first. Very good morning to you, Morris. Okay, are you able to see the document as well? Hello, Bob. All right, looks like we are done with all the technical system check is over. So now we can get started to talk about some real issues. So while we wait for some other folks to trickle in, let's warm up for the session. So today we're gonna talk about buy now, pay later, and I promise we're gonna cover that today. We're not gonna leave it for the next session. This is our catch up from our previous session. So Bob said, now we can party. Sure. I think the party is on, depending on what side of the market you are. There is always a party happening somewhere. Like they say, there is always a happy hour in some part of the world. And third thing is there is always a bull market somewhere. We just have to find the right place to party or to find the bull market. Yeah, party now, pay later. That probably seemed to be the mantra of Gen Z. I'm not in that camp, but that doesn't mean we won't analyze this industry and try to profit from it. But it's an interesting play that been noticing around buy now, pay later. This has become very popular, I would say, in the last 2 years, with multiple players coming in. So we'll talk about that. And a lot of action happening around that. Saw a lot of action on the crypto side of the world as well, with the infrastructure bill and whatnot. So we will talk a little bit about that. And of course, we'll look at some of the earnings. So, all right, so let's get started. I think we have decent quorum to get started. So thank you everyone for joining in today. We are in discussion number 97 for options for retail investors. So when we just first started discussing, these put up this meetup group, we were only discussing just the options education. But then I soon realized that jumping onto options without knowing which ticker you want to trade is a recipe for suicide. So started to diverge and understand more about market, how to analyze stocks, finalize which stocks we want to take positions in, then use options to take those positions. So we kind of separated into two different sessions. Saturday we discussed only how to become a better investor, and then Tuesday we started discussing everything about just options, different option strategies, how to use options for managing portfolio, the delta, theta, gamma, everything of the options. So all right, so it's now number 97. Been analyzing a lot of stocks, looking at the markets. That's what we're gonna do today. So today on our agenda is look at the market, how the markets have been performing. Look at some of the new things that I'm seeing in the market. We'll focus on buy now, pay later. I'll spend 30 to 45 minutes on talking about this new industry. And as always, in the end, we'll discuss one option trade as well. If you have any questions, put it in the chat. I'll be monitoring the chat window as we go along, or speak up. Both the things are fine. But before we jump into it, please understand everything that we're gonna talk here, everything that we're gonna discuss here is only for education. This is not an investment advice, neither a tax advice. Consult your paid advisors if you really want to get a professional advice. we can give you some friendly, we can have some friendly discussions to learn about markets and the industry in this session. All right, so let's get into today's session. I'll skip the quote of the week because we're going to talk about that later. Let's do a quick market recap or wrap up. We got a couple of numbers from our inflation side. CPI, we saw CPI increase by 0.5%, which was better than what we saw in June, because in June it was 0.9%, almost a percent. But in July, it was still positive. So inflation continues to raise its ugly head. Fed thinks that it is transitory. There are different opinions. I don't think that it's going to be transitory, because there are some components of inflation that are not transitory. Those are not temporary. Those will be baked into the prices as we move along. Some of the pressures, or some of the reasons for higher inflation, the ones which are caused by the disruption in the supply chain, that will probably roll back. That could be transitory causes, but there are a lot of other reasons for this inflation going higher. Those probably won't roll back. So we'll have to see. But inflation continues to run hot. And we also got producer price index. This was a consumer price index, means we as a consumer, how it impacts us. And this 0.5% is not really what impacts us. If you really go out and look at, in the markets, the real prices are way higher for most of the products that we use, but probably those don't even get counted in the CPI. So PPI, which is producer price index, which means how the companies are facing, the companies which produce goods, how their costs have gone higher. So it looks like those costs increased by 1% for the second consecutive month. Now, my understanding is that the CPI will follow PPI, because if the producers are finding, if their cost of making goods have increased, they will soon raise the prices of the products that they will sell. And we as a consumers, when we will be buying those products, that will increase the CPI. So I guess the CPI, which is 0.5% in July, is kind of a misleading, because the PPI is higher. And maybe we will see an increase or bump in the CPI because of that later on. This may be a leading indicator for CPI. Other thing that we saw on the macroeconomic factor is Senate passed roughly $1 trillion bipartisan infrastructure package. There's a lot of back and forth that happened on this package. We talked detail about why it was held up. One reason was because of the crypto tax. There was a huge discussion that happened on how we're going to pay those $28 billion that was earmarked as a income coming from crypto tax. There were a lot of discussions on that one. In the end, nothing changed. The infrastructure bill was passed the way it was drafted the first time. There are a couple of amendments that were proposed, but nothing got no changes that happened. So we'll see how this infrastructure bill, what impact it has on overall economy, and plan accordingly. There was concern that it will impact the whole crypto economy, but actually it did not. The crypto world took it in its stride, and we didn't see any major impact on that one. So your question, we just said CPI, PPI uptrend setting up for October major correction. In a normal times, yeah, we would have guessed that the CPI, PPI is going higher. So Fed will start to rein in inflation by increasing some rates. That will make stock market go a little wonky. We might see some corrections. But President Biden came up on the TV and told that Fed will do everything that they can to, to tame inflation. And on the other side, Fed is also saying that they'll do everything they can to stabilize the markets as well. So it's very difficult to now think because that there will be a correction coming in because the markets are not free anymore. And I guess the Fed is in a precarious position of, if they increase the rates and the market, start to show its tantrums, they'll probably soon decrease the rates. So it's a difficult position right now. I don't think we can guess it in either direction, whether it's going to be correction or will we continue to see what we have seen for last 9 months. There are some the additional, the COVID related packages that will be rolled back. Those might have some impact on economy, but because of inflation, markets are now not free markets anymore. And Fed has continued to buy almost $130 billion worth of mortgage backed plus the bond buying program. So as long as Fed continues to increase its balance sheet, it's anybody's guess how long this bubble can continue to blow up. But some point of a time, these things will come back to normal. But when will that be? That's anyone's guess. But I'm always prepared for correction. I think that's a healthy correction. So I'm not increasing my exposure to the stock market. If at all I'm doing it, I'll probably reducing my deltas in my portfolio. But that I've been focused on doing it for last 2-3 months. Haven't really worked out that great because market has been going up. But I'm a little cautious of being bullish at this point of a time. But that doesn't mean that the markets are actually going to go down. But we can, as a retail investor, we can position our portfolio best based on what we think where the market will go. But eventually market could go anywhere. So I'm not pulling out from the markets, but I'm not adding any more capital into the market for now. That's how at least I'm preparing for. And rather I'm looking and finding more opportunities around the crypto side. So that's where the new money is going in. And the stock market side, continue to reduce deltas by selling premium in terms of covered calls or call spreads, or do a defined risk trades. At least that's going to be my focus for next 2-3 months, whether there's a correction or not. I find it very hard to still have a bullish outlook at this point of a time. So quick look at the market sectors. Financials, up 5% last week. Again, the thought process is still the same. Inflation running hot. We expect Fed to start increasing the rates. A couple of Fed governors, I don't recall which governors were those, but they came and told we'll probably increase the rate sooner than what we were expecting earlier. So that gave a boost to the financials. Higher the rates, better for the financials, because now they can start to charge more for all the loans that they provide to consumers. So that's why we see a lot of action in the financials. And then there were around the materials is all powered by the infrastructure talks. So we saw almost 4% jump on materials as well as industrial. So overall, I think market still continued to chug along. It was still up 0.75% for this week, which is surprising. So for this year, it's already up close to 19% S&P. Isn't that amazing? From the extreme valuations of that we saw in 2020, we are up again almost 19% in 2021. That's why I find it very hard to be bullish at this point of a time. That was a similar situation for me in 2019 as well, but markets were up 30% in 2019. But another thing that caught my eye was it's not just S&P. If you look at the best performing asset, there was a comparison between gold, S&P 500, and Bitcoin over a 10-year period. This was a discussion between, I picked up this screenshot while I was watching the discussion between a major proponent of Bitcoin and the opponent of Bitcoin, and a very big gold backer. So there was a lot of discussion back and forth between gold versus Bitcoin. So an interesting chart over there. Looks like, and I didn't know that, but gold probably hasn't performed over if you look at last 10-year period. Gold is now barely back to where it was 10 years ago. So if we bought some gold 10 years ago, we are barely making it. So this is around 2020. I mean, this is now the recent one. This particular may not be like 13th of August, but maybe by end of July, because if I look at S&P 500, 286%, and over here for Fidelity, it says 10-year is 280%. So this is not very off. Maybe this chart is from this year itself. Means 2021. So the other viewpoint is because gold hasn't performed for so long, so it is ripe for an upside movement. But we gotta see, there is a lot of other discussion I'm seeing and readings which says now the gold and the crypto assets are being competitor. The reason why gold hasn't been able to perform the way it should have, given the concerns around inflation, etc., is because the money that should have gone to gold, some of that is also flowing into the crypto assets. But this is a really, really interesting chart. 469, or like 500,000% up. You can ignore all these. This was like 1/100th of a pennies. But S&P been amazing. 10-year it has returned almost 300%. So it has been I would say it's been a tough decade for gold bugs, all gold holders. Sam says, how much was S&P up in 2020? Do we have, this says 1 year. I think this is from, let's say, last 12 months. We can look for S&P performance in SPY 2020. Let's find out how much was S&P of 2020. Does it show here? In the last 10 years of 15.23 in 2020, hopefully it shows here something. Someone has done some math already. 20. Oh, this was talking about a dividend yield.
Vivek,
Yeah.
I answered the question on the bottom.
Oh, okay. Oh, yeah. Oh, okay. Thank you. Yeah, it's finished with a gain of 16.3%. All right. So yeah, 16.3 plus you add the dividend. Yeah, NASDAQ was up 43%. So 16% was the last year, 2020. And in 2021, we are up 19% already. And we still got 4 months to go, 4.5 months to go. So I find it a little hard to stay bullish, given the valuations that we're already seeing. These are the highest level of valuations seen ever. And I don't know how long will this continue to go. This all have been, and not just US markets, all markets across the world are on fire. And the reason is all have been bored up by the free liquidity from central banks.
The people on CNBC says market still is going to go up this year.
Yeah, depend on which people on CNBC you talk to. If you listen to Muhammad Al-Ahrian, he's always bearish. If you listen to Tom Lee, he's always bullish. So Tom Lee's target for 2021 was 4,500 for SPX. Now it is within a kissing distance of 4,500. Now Tom Lee is saying maybe we can actually go to 475, 4750. So he is always bullish. There are a few folks which are always bearish. So depending on what time you tune into CNBC, who is speaking, you could actually get a completely different opinion. So be careful if you're trying to form opinion based on what you listen or see on CNBC. It's generally always divided. I mean, it's a marketing channel. CNBC is marketing channel. I'll definitely not take financial advice from CNBC. Another one from Brian Ferrolli. So I find Brian Ferrolli, I follow him, and I find him, his thoughts on personal finance management and personal investing really great. So let's look at one from him recently. Since IPO, CMG has declined 10%, 21 times. It had lost 75% of its value once. But if you still able to weather this volatility, since IPO, it has returned 4,000%. I know this is difficult for us to go through when we see some stocks going down 20%, 30%. When we start to have a jitter if the stock goes down 5%. But the only way to go through this volatility is to spend time in building the conviction on the stock. That's the only reason. In my personal experience, that's the only way to build conviction and go through this volatility. In my own personal portfolio, if I bought some stocks because some of my friends told it's great, I haven't spent time in looking at it or haven't looked into the analysis done by anyone else, those are the first ones which I'll dump the moment market goes down or those stocks go down, because I have no conviction on those. I bought it because either I heard it on CNBC or some of my friends told me it's a good one, but I didn't spend time in reading about it or in going through the analysis done by anyone else to build my own conviction. But this stat, I think it's pretty common. It's not just to CMG. Yes, if you pick up any great stocks, when I say great stocks, not just for the last 1, 2, 3 years, but over 5-year, 10-year period, almost all of them would have seen 40-50% declines. Or those would have been a stock which probably haven't, there will be cases where they haven't done anything for 5 years. Stocks like Nvidia, Amazon, Apple. There have been periods when they are done Nothing. They haven't returned anything for their shareholders. Amazon hasn't returned anything for this year. Look at Amazon. It's been just range bound for this year. So if you look at, yeah, or I would say for last 18 months, Amazon hasn't done anything. So this was here in July of 2020, and we are still here in last 12 months, in the end of July of 2021. But I still have conviction on Amazon. I'll continue to hold on this one. So it's important to build that conviction to go through this volatility. But volatility is normal. Volatility is the price that we pay to enjoy those extraordinary returns. So that's the price that we have to pay. The other thing that caught my eye was the fight for the operating systems. Oh, I see one question. Morris says, would be interesting to see what cash did over the same 10-year period. Cash will have gone down in value because of inflation.
Of course it would. The question is how much.
Yeah, we don't have the chart, I guess.
Yeah.
I mean, if we assume, Morris, that it's like 2% per year, you can just compound it and see how much comes to be.
And like I said, it'd be an interesting comparison.
Yep. What I didn't see here was because this was a debate between the gold bug and a Bitcoin, gold bull and a Bitcoin bull. I want to see what the real estate, how the real estate has done, because that's another one category of asset that a lot of us hold, or generally retail investors will hold in their portfolio, but we don't have that number. OS Chromebooks, yeah, we'll talk about it. Ramesh says CMG dropped to 200 from 700 due to food poisoning. Now they have a CEO from Taco Bell. I like it for option trades and done well. Yeah, so I remember those times when the original founder, they had to remove the original founder, bring in the current CEO. I think his name is Brian Nichols. Or Brian Nichols or Target, because there were changes in two CEOs, and I sometimes get confused between the Target CEO and the CMG CEO. But anyway, the Taco Bell guy came in and completely changed and brought in some of the good practices that are implemented in Taco Bell onto the CMG. Yeah, so at 200, I think it was 250, it fell down. But at that point of time, everyone was running out of the door. And I recall Bill Ackman, the owner, the hedge fund guy from a Pershing Square Capital, he has a very concentrated and bullish position on CMG at that point of a time. And he in fact went and ate on Chipotle just to allay the fears for investors around the whole food poisoning and all that stuff. It was just saying, everything is okay. And eventually those who stuck with CMG at that point of a time probably had reaped all those returns. Now CMG is what, around 1600, 1700? I don't have any position on CMG. I haven't traded CMG much. I know it's a good taker to trade option, but I haven't been, it's almost 1900. Has done amazingly good. So this was a case where they had a food poisoning. No, not here. Over here. Somewhere here they had a food poisoning issues. They went all the way to 250. but it could continue to grow. It's just $53 billion. Only $53 billion. And we have lot many ID companies with much lesser sales and way higher valuation. So could continue to go higher if they can continue attract consumers. And actually, I find the whole experience of ordering online on the Chipotle app pretty amazing. So during the COVID, and I'm fan of Chipotle. So during the COVID, we used to order often from Chipotle, and I downloaded the app, and the experience of ordering through the app has been, and the whole overall fulfillment experience, right from ordering till the pickup, has been great for me. So I continue to be a happy consumer of a CMG, not a shareholder though. I don't know why I never pulled the plug on CMG. IV rank is close to 0. It could be because they had their earnings recently, and then the IV would have just crashed after the earning. So may have to give some time for earnings to come back up, or for the IV to come back up. That may be a reason why the rank is close to 0. I see in a lot of the stocks where I want to do some trade, but if they recently announced earnings, that would have resulted in IV crush, bringing their IV rank way below where I'm comfortable with. So that may be the case with CMD. Other thing we're watching in markets, the fight for the operating systems. So we had two biggies on the computer operating systems with Microsoft on Mac OS, and like Samuel mentioned, now we got a Chromebooks as well. So I think it makes sense to add Chromebooks. It's a Chrome OS. So put it Chrome OS. This is a recent one from Google. On the mobile side, there are two big players, Android and iOS. But now the third battle is happening on the TV operating system. And that battle is between Samsung, LG, Roku, and the recent player Google. And the Google player is not recent. They've been trying to do whole Google TV. They also had the Chromecast and all that. But the news that caught my eye was TCL now announces new 6 series, 5 series TVs that will come with Google TV instead of Roku. So TCL has been a long-time partner of Roku. Their Series 4, Series 5, they all had a Roku operating system, Roku OS built into TV. But this week, now they're expanding beyond Roku. And market took notice of that. We saw some weakness in Roku after this announcement. Go back to the daily ones. We saw some weakness. This happened this week. I think Roku was around 400. And now what happened? And we saw if this becomes more pervasive, and if the Google TV is as good as, let's say, Roku, or better than that, then it does. Now, Roku is not the only player remaining on the TV OS side. I never thought that we'll see a battle for the TV operating systems. But here it is. Roku was the only player. Now Google is coming on board. Haven't seen much news around Samsung's has got some Tizen or Tizen. I don't know how you pronounce it. It's Tizen. I think that's their connected electronic appliance operating system. They are also used, that same OS is also used for Samsung's connected refrigerator as well. And then I think LG has got some web OS, but nobody talks about that in the market. So it is possible that we may have two big players on the TV OS side, which is Roku and Google TV. So the fact that the Google has so much of money and they can just spend money like crazy to build up their TV business, that Roku will be forced to fight with them. That caused some concerns among Roku investors. In any industry where you get a big player, the player with the deep pockets, the incumbents always get jitters. So we saw some weakness on Roku. A quick look at the market sentiments. This is being published by Citibank. Market momentum says S&P 500 is almost 7.3% above its 125-day average. This is further above the average that has been typical during the last 2 years and indicates greed on part of investors. Says greed, take it with pinch of salt because this market can still continue in the same fashion. The odometer reading is at 44, and this doesn't show it agreed, but again, like I said, markets can still continue up because it's a free liquidity, a lot of money in the markets, and not just the public markets. We're seeing similar stuff on the private markets as well, in terms of the money that goes in the private markets and the valuation that some of those private players, private companies are commanding. Simply inexplicable. Let's look at some of the earnings. Disney continues to perform. The shares went up immediately after the earnings, and the next day when it opened, it was up. Finally, it closed down almost unchanged, but it hasn't done anything for last 2-3 months. But if you've been selling options or kind of a strangles on Disney, those trades would have worked the best to reduce the cost basis. But let's look at Disney numbers. I'm more interested in the numbers of what the number shows us from a business perspective. So overall revenue increased 45% year over year to $17 billion, which is great. Their free cash flow is up 16%. But more important is the overall subscribers, they continue to grow high. Across their all properties, now Disney has 174 million subscribers. I had one more chart. I don't know where did that go. It's a comparison between Disney and Netflix. Oops. Oh, maybe I lost it while I was rearranging it. There was one more chart that shows the comparison between how Disney is inching closer to Netflix in terms of their subscriber base. And I also had one, let me just bring that up, had a segment-wise breakup of Disney. So let me just bring that up. Let's look at the report directly. That was more interesting. This is the overall, but there was a segment-wise breakup. Oops. Yeah, this is what I wanted to show. I think I lost the chart and this table. So overall revenue is up 45%, but what's more interesting to see is their Disney parks. Now with the economy reopening, that's up almost 3 times. So last year, because of all the lockdown and all the closures, they made only $1 billion, which is surprising that they actually made some revenue. But this quarter, they made $4 billion. So More important, let's look at their the media and entertainment. That's up 15%. So if economy continues to open up, we should see more increase in this one as we move along. So overall, I think Disney is still doing good. I don't see any issues from, as a shareholder, I'm not worried. This is a company which I'll continue to hold because it got a play on both sides, economy reopening play as well as lockdown play. If it reopens, parks will do good. Their movies business will do good. If it's closed down, the Disney Plus will do good. So no concerns from a Disney perspective. This is one stock that we can hold and put it in the vault. Let's look at NIO. NIO is EV based out of China, a competitor for Tesla. And again, when we talk of EV, I want to focus on the delivery of vehicles, how those have done. So the overall delivery for vehicles for NIO were close to 22,000 vehicles in Q2 of 2021, which is an increase of almost 100% from last year. Again, understandable because last year was a lockdown and the sales would have been depressed, but good to see that this quarter sale is almost double of the same sales last quarter. And they also have a healthy balance sheet, hold $7.5 billion on their balance sheet. So still continue to stay bullish on NIO, though they do have competition. Some of the other companies within China, like BYD Auto, they have done better than NIO in some of the international markets. So they do see some pressure from BYD. There are other companies, Li Auto, Xpeng or Zheng. I don't know how exactly to pronounce because I've heard both pronunciation, XPEV. That is again EV market. Oh, sorry, EV company. There is a BYD Auto. Okay, this doesn't show BYD. And then there's a Li Auto. These are some of the players these are some of the EV players in China. I have positions only in two, NIO and XPEV, just to hedge it and not put all the eggs in one basket when it comes to EVs in China. But NIO is much bigger position than XPEV because I've been in NIO for a few years now. And I continue to hold my position, continue to reduce the cost basis. The results were okay. The markets didn't like it. So after the results, it fell down almost 3.5%. But as a shareholder, from a numbers perspective, I read through the detailed a press release on across all the numbers. I didn't see anything which is concerning for me on NIO. So continue to be shareholder for NIO. Next earnings is the Rocket Mortgage, earlier known as Quicken Loans. And this is one company where, I think this, sometimes I feel that from a numbers perspective, they continue to put up such a great numbers, but kind of caught in the whole macro headwinds of low interest rate, and being a mortgage company just doesn't get the love that it could get from the markets. So anyway, a quick financial highlights. They actually doubled the revenue from 2019. So Q2 2021, the revenue was $2.7 billion, which is more than double of Q2 2019. Now they are not comparing with 2020 because 2020 brought in a lot of tailwinds from zero interest rates and a lot of liquidity, which was added by Fed. But more importantly, I saw their net profit numbers. Like out of a $2.7 billion, they made $1 billion of net income. I think I have that number somewhere. Oh, hold on. Yeah, generated net income of $1 billion, which is huge. So I think they recently got some street upgrade. That's why we saw some action up after the earnings. Went up close to 10%. But the way I was looking at the business is now they're expanding into a lot of different categories as well. And those are yet to play out. And I think at this point of a time, they are now the, if not the top, probably the second largest mortgage origination company in US. And someone told me that actually they've exceeded Wells Fargo, and probably now they are the largest one in home mortgage. Let's look at the business highlights. The net client retention rate was 90%. Their new business, Rocket Homes, 2-month average unique monthly visitor, which is 6 times as compared to last year. Rocket Auto, which is again a new business, they facilitated the sale of 15,600 auto units, up 143% as compared to last year. Okay, we can discount this because last year, because of COVID, not many people were shopping. So maybe let's ignore this one. Now they're entering into solar energy as well. Again, to help consumers when they're buying their homes, they help with mortgage. But if they also want to get solar installations, they'll be able to help them even with the solar installations. So pilot will begin in the 4th quarter of 2021. Official launch will happen early next year. And they also forged a new relationship with MassMutual, and the insurance agents of MassMutual will also help in home loans origination. So overall, I think I still like this company. The stock hasn't done that great as good the business has done. Now they become, I think now they become the top dog in a home loan origination business. And with this kind of a business and this kind of a profitability and the optionality, I still feel this has got a lot of runway, which is not reflected in stock yet. Again, my opinion. I was pretty pleased to see the numbers, to see their P&L statement. Lastly, Coinbase, unless there are some questions. Nope. So Coinbase continues to surprise and perform really, really well. So they had a $2 billion of net revenue, and like Rocket Mortgage, $1.1 billion of adjusted EBITDA. It's adjusted EBITDA, which is okay. They'll probably would have removed the stock-based compensation from this. And overall, 68 million verified users. Robinhood has got 28 million. Coinbase has got 68 million verified users. More important is the relationship with 9,000 institutions. So a lot of big institutions those who want exposure in crypto, they generally work with Coinbase. There are, of course, other regulated exchanges, Gemini, Kraken, in US, FTX, Binance.us, but the most stable and the trusted one is Coinbase. More about 10% of the top 100 largest hedge funds have chosen to onboard with Coinbase. And they also disclose that Elon Musk, as an individual, PNC Bank, SpaceX, Tesla, Dan Loeb's Third Point LLC, they all are customers of Coinbase. But as with crypto, Coinbase will go in the direction the crypto economy goes. If there's a crypto winter, Coinbase will catch cold. If the crypto continues to do good, Coinbase will continue to do good. So if you want to take an exposure, understand and follow the crypto economy, what's happening over there. That's generally how the Coinbase have been performing. But the results were pretty surprising. I think market wasn't expecting them to put up such numbers. So AJ says, Intel invested 800 million in Coinbase. I did see, I don't think it was 800 million. Because I was surprised that why it was even a news, because the number that I saw was very less. I think it was just, it was, yeah, it's 800K. So I was a little surprised on, is it even newsworthy that it has got only 800K, not 800 million. 800 million would, yeah, that would have been a really big news, but it was only 800,000, which was, I'm like, I don't know why do you have to spend this ink on this one saying they got 800K, which is like nothing. So I kind of ignore that as a noise than a news. The amount wasn't big enough. Asif says, would interest rate increase in 2020 affect Rocket, UPST, Sophie hard? No, if interest rate increases, this is going to be good for Rocket Mortgage. Then the mortgage rates will go higher. And it will be good for the financial sector. So if Fed comes and increase the base interest rate, we will see a mortgage rates going higher. Right now, it's all-time low. Why? In fact, I am in process of refinancing again. I sent across the documents on Thursday. Did a not DocuSign. My mortgage broker uses some other DocMagic, another company, to sign the documents electronically, which I did yesterday. I'm in process of refinancing because the rate I refinanced last in 2020 in the middle of pandemic, and my broker told me, "Hey, rates have come down again." Sure. Why would I want to pay higher rates if I can get by, lower ones? So I'm in process of refinancing my home. But if the rates increase, mortgage will go back up. So it won't stay so low. So right now, what I'm looking at is I don't even recall. It's just tad less than 2%, 1.95% for 15-year. Eugene asked, what company are you using for refinancing? I go through my friend. I know him for 20 years, more than 20 years. He is a mortgage broker. If you want, I can tell the reference. So he's a mortgage broker, and he'll find the deals. And for me, it's Arcus Lending. Asi said, thanks, but demand and revenue might go down for consumer loan companies like Upstart and SoFi. So from a consumer demand perspective, I think at least for the next 1 year, there is so much of a pent-up demand And I think consumers also have a money stashed up in their accounts, savings accounts. If you look at the balance on the customer accounts, I think there's almost 4 trillion worth of the money which is in customers' accounts. So I don't think that at least for a year it's gonna make a big dent. I could be wrong, but there is so much of a pent-up demand among consumers to go and shop and buy that increase in the rates may not impact the sentiment from consumers. Now, home loan could be a little different, from a mortgage perspective, because that's a huge amount. So again, we'll have to see in terms of how much is the impact in terms of the home loan originations if the rates increase. Mr. Rocket was in the same boat as Ford, did not get the love from market since Alan Mulally left. Now both the stocks are moving higher. Yeah, so I'm also bullish on Ford, and you're right, that hasn't got love, but I only turned bullish on Ford after their EV plan. We actually saw Ford have 150 electric E150, the demo of that, and I'm a little bullish on Ford now, but with the complete awareness that it will take long time for the story to play out. Any of the EVs stories coming from GM and a Ford is gonna take a few years for them to show up. And in the meantime, we'll continue to reduce the cost basis of share ownerships. But I can afford to be bullish on Ford and GM, but not on Tesla right now. What is online insurance platforms? Didn't understand the question, Samuel. Are you looking for, is the question related to life insurance? We can go. So there are, I know one, InsurTech. Okay, there are many companies. I haven't really studied this from an investment perspective, but there are many online insurance brokers. You provide your details, your age, and whether you smoke or not smoke, what's your condition of your health, and they'll bring up the various insurance quotes. So Coinbase surprised the markets and got the love from the markets after they reported the results, and then again went down. This is gonna go the way crypto goes. So be careful if you want to take position in Coinbase. Disclaimer: I have no positions in Coinbase. If I'll do any position, I'll probably do a bearish position in Coinbase just as a hedge against the crypto positions. I don't want any more crypto bullish exposure. Lastly, I saw an article in Wall Street Journal. So here's a quick summary of that article. So that article was gold as an inflation hedge, what the past 50 years teaches us. So it's not based on what happened to gold in the last 10 years. So earlier we saw gold hasn't done anything in 10 years, but this was a study which looked at gold for past 50 years. I'm interested in this because gold is in top 10 of my portfolio. So I read through this. Quickly want to share some quick tidbits from it, not the whole article, but some excerpts from that article. So 50 years ago, on August 15, 1971, is when US had taken dollar off the gold standard. So if you're not, maybe let's go back a little bit in history. What we call as the money, historically, the most solid money, the money which is which has got some value, the base layer of the money, it was gold, and that has been there for thousands of years. There's a book, if you are interested, you should read The Laddered Money. So I'm just borrowing some of the concepts from there. So this is called the most stable form of money. And in 1600s and all that, because you carrying and exchanging gold is a little tedious, so merchants started to give an IOU based on gold. So if you hold gold, if the consumers that hold gold, they basically gave those gold to merchants or to goldsmiths. So let's say goldsmith will give them an IOU, which confirms that this merchant really has a gold, which they have given it to the goldsmith. So now that, and people started using this IOU. So IOU became layer 2, second layer money. So this was a layer 1 money. So then from IOU, so I would say these are like earliest type of bankers. So the earliest bankers, primitive form of bankers, were actually goldsmiths in 17th century and 18th century. They performed the role of goldsmiths. And then the first central bank called Bank of Amsterdam, that was formed, and basically their whole idea was to deposit all the gold with the Bank of Amsterdam. They'll come up with the equivalent paper money, which if you want, you can exchange it for a gold. So that was how the overall money concept was there for hundreds of years. And even in 20th century, we had the same concept. Now US, so around after World War I, so prior to that, every big currency in the world, whether it's US, whether it's a British pound, which is called sterling, they all were based on either gold, all were based on gold. I think GBP had gold and silver. They were pegged to gold and silver. Means if you hold a pound or if you hold a dollar, the central bank that have issued that dollar actually holds a physical gold in its vault, because that dollar derives its value from the gold. So gold was layer 1 money. Dollar became layer 2 money. Now we have a lot of layer 3 money. We got a PayPal, we got a credit cards and the PayPals like layer 3, layer 4. But gold used to be the layer 1 money. Now, and that was the case until 1971. So 1944, 1945, because all these different currencies of the world, and if you have to increase your international commerce, rather than trying to trade in different currencies, there was an agreement called Bretton Woods Agreement, in which all the major central banks across the world, they agreed that all of them, they will peg their currency against US dollar, and US dollar will be pegged against gold. And the conversion was 1 ounce of gold will be equal to 35 US dollars. So if Fed is printing more USD, we need more gold in Fort Knox. Otherwise, Fed cannot print more USD. You have to have an equivalent amount of gold. And no one trusted just the paper money. That paper money need to be backed by something, which was a physical gold. And the agreement was that now instead of every central bank trying to worry about it, they will basically peg their currency against USD, and US Fed will ensure, or US Fed will peg USD to gold. It worked for 25, 30 years until 1971. In 1971, Nixon decided that we are ending the convertibility of US dollar into gold. But prior to that, if you held US dollar, you could actually go to your bank and demand, 1 ounce of gold, for 35 US dollars. Because by law, it was a convertible. By law, each US dollar was backed by a physical amount of gold until 1971, in which we basically ended the convertibility and say, you know what, US dollar will not be backed by gold anymore. And we directed all the US citizens to not hold gold. So gold possession was made illegal. You cannot hold gold. US citizens were asked to deposit the gold with their banks, because only central banks were allowed to hold gold. So what is US dollar then backed by? Nothing. That's where the US dollar actually became of what we now call as fiat currency. It is only backed by the promise of Fed. It's not backed by gold anymore. So after this, we saw a huge, and because the reason why they removed this convertibility, because government and the Fed, they wanted to print a lot of US dollars. And if you don't remove this convertibility, then you have to hold that amount of a gold, which we did not have. So because we did not have gold and we wanted to print more US dollars, the only way we could have done that is to just take the US dollar off the gold standard. And then we don't have to worry about getting more gold into Fort Knox. Then we can print whatever we want to print. And the funny thing is, a lot of countries, the central banks around the world became skeptical of US. And in Fort Knox, it not only US gold is stored, but even the gold from other countries is also stored. So France, those are interesting stories. Sometimes it's fun to go back in history. So France government actually sent some warfare, these warships over to US to just get their gold back. They were all concerned about, we don't know what US gonna do with the gold that the other governments had kept with US Fed. Anyway, so that's little throwback, going back in history. That's why we call it as a fiat currency, because it's backed by nothing but the promises of Fed. I see a question. When you refer to gold, does it apply to gold asset class, gold, silver, platinum, minor, gold trust, etc.? I think this is, when I say gold, it will be like the pure convertibility into gold. Either it's a gold or GLD. This is not, this study does not include silver or platinum or other precious metals. But this convertibility was purely on gold. So it's an interesting book. It's not a very, I would say, not too many pages. It's a pretty good book if you want to read it. It's called The Laddered Money, which explains how the money itself has changed forms from just being how we moved as a society, how we moved from rice stones as a money to gold as a money, and now the paper as a money. Okay, coming back to today's world, gold as an inflation hedge. So the apparent correlation between gold and inflation, which means if the inflation goes high, the gold goes high, that has led many to believe that gold is a good inflation hedge. I was of the same opinion. That is why I still hold gold in my portfolio. When I say gold, I hold GLD. But this belief isn't supported by data, however. If the gold were a good and consistent hedge, the ratio of gold price to the consumer price index, what we talked just now at the start of a session, would be relatively steady. If gold goes high, if the consumer price index goes high, means the inflation goes high, gold should go high. So the ratio should be steady. But that hasn't been the case. As you can see from this accompanying chart, which goes back almost 50 years. The ratio of gold price to the consumer price index. 50-year average is 3.5. But we have seen this as high as 8.5 and as low as 1. So it's not consistent. However, what this study also found that gold is only a good inflation hedge over time frames far longer than any of our investment horizons. So if you want to take gold hedge as a protection, think of it as a multi-generational asset, not an asset of one person's lifetime or investment horizon, which is an interesting concept. In the study, they found that it's only when measured over long periods, a century or more, gold has done relatively good job in maintaining its purchasing power, which means as a hedge against the inflation, as a hedge against decrease in the purchasing power because of money printing or inflation going high. Over shorter periods, its real or inflation adjusted price fluctuates no less than that of any other asset. This was an eye-opener for me. The reason I hold gold is again hedge against inflation, but my investment horizon is not a century. My investment horizon is not 50 years. So like we say that gold is a standard, gold has retained its value over centuries, which is true, but you need to have that investment horizon, which is multi-generational. This study found that it doesn't really work as a good hedge for inflation over a shorter period of time. So does that mean we shouldn't have gold? Or if it is not inflation, what other reason why someone could hold gold is maybe it generated good returns? So I don't think, okay. So we already saw another chart of the gold returns versus S&P 500 returns. So we don't have to go this again. But we know that S&P 500 has returned way better than what gold has returned. So it's not an inflation hedge. It's not a good return. So what role does gold play in your portfolio? So it's a little interesting to find out in terms of why should one hold gold if it cannot protect against inflation over a shorter time period that I have, and it's not a good asset to hold from generating the returns. I would rather hold S&P. I hold stocks, but those are generating way better returns than what gold has been. Okay, so let's look at the reason why could someone still hold gold. The correlation of its returns with those of equity or bond often has a low or even negative, which means if its correlation is negative with respect to the stocks or bonds, it reduces the portfolio volatility. So over past 50 years, a stock and a bond portfolio could have improved its risk-adjusted performance by adding small allocation to gold around 5% or so. Okay. Volatility is again another form of, I would say, risk, because if we cannot weather 15-20% downward movements, we don't want our portfolio to be that volatile, then gold does serve as an instrument to reduce the volatility in your portfolio. It's not great as to increase your returns. It's not a great hedge against inflation, but a small allocation around 5% does reduces the volatility in your portfolio, does reduces the standard deviation of your returns in your portfolio. Means when I talk about volatility or standard deviations, is like if your portfolio is returning like this, having little bit of a gold, which a study has found like 5% allocation, could have reduced the volatility in your portfolio. You probably will have a little lesser return, but you might sleep well. So this is sleep well investment, because if you cannot go through, these drawdowns in your portfolio, having gold in your overall portfolio reduces this volatility. So I think that's the overall objective. That the takeaway from this particular study. But it was an interesting one. So now based on this, I have to take a decision on how much gold do I want to hold in my portfolio. If it really doesn't serve a big, inflation hedge or a return generator at shorter period of time, but I think I'll still continue to hold gold. It reduces volatility. Yeah, I want to have a lower standard deviation in my portfolio returns. I'm not the one, who's comfortable with 50% up in 1 year, then 20% down in another one, 40% up. That's too much of a volatility. So if it can smoothen out the return profile, that's a good thing for me. You can decide what works best for you. Holding GDX or GLD trust is a good proxy for gold. So if you're on really looking at good proxy, it will be GLD. So GDX or GDXJ, I've seen that it does deviate. It's not 100% correlated with the gold, but GLD is actually backed by gold. So if you want a pure exposure to gold, it will be GLD. GDX or GDXJ, these ETFs have exposure to miners, which means if gold goes high, those miners who are pulling the gold out of earth will benefit. So there is some correlation. But remember, the miners could also be impacted by some other macroeconomic factors. So sometimes, and I have exposure to both GLD as well as GDXJ, and some days I'll see GLD is up and GDXJ is down. So it's not always correlated. But if you want exposure only to gold, GLD is more closer to gold than the GDXJ would be. Gold, if it's gold assets move in the same direction as stock market, just less. In last few years, we have seen that many of these assets have actually become correlated to each other. Gold, bonds, stocks. But that hasn't been the case historically. So if you expand the time horizon, the correlation between gold and the stock market is, at least this study has found, over 50 years, it's actually negative. So it does provide you a hedge against the volatility of the stock market. If you're talking about the COVID, in COVID, the diversification went out of the window. Every damn thing was correlated. So the traditional diversification strategies, which says have so much in bonds, 60 stock, 40 bonds, or your 100 minus or your age is stocks in the rest in bonds. All those diversification strategies just fell flat during COVID because everything became correlated. And it does happen that during those extreme measures, we see all the assets become correlated. But if we ignore those specific instances, look at over a longer period of a time, that's what the study has found, that over a longer period of a time, it has got some negative correlations with the stocks and the bonds portfolio. Yeah, last year isn't where we should base our strategies on. Last year was an anomaly. We can't use last year to now plan for the next 20, 30, 40 years. All right, so I'll come back to this one if we not finish this one, which is again an interesting one. Like I said, I'm more and more interested about how your mindset during investment. And I read and also I listened to a podcast where they talked about how your mind could be sabotaging your portfolio, how your brain could be sabotaging your portfolio because of some biases that we have in our heads. We'll talk about it later if time permits, because I want to go through buy now, pay later. And if we have more time, we'll come back to this topic of, again, mindset discussion on how some of the things that happen in our brain, which we may not even realize unconsciously. So we have to make an effort to realize those things, because those may be damaging to our portfolio. We'll talk about that later. Let's focus on buy now, pay later. Before that, any other questions? Let me see if I missed anything. No, I think I answered all the questions till now. Okay, so let's talk about buy now, pay later. Before that, anyone over here actually have used buy now, pay later services? Anyone used? Okay, I see one. Credit cards. No, when I say buy now, pay later, I'm looking at the specific players which are categorized under this category called buy now, pay later. I mean, credit card is form of, yeah, I buy now and pay later. A loan from my dad is buy now, pay later as well. But I am looking at, have you made use of services like Affirm, Klarna, those services which are specifically called buy now, pay later players? No. Okay. All right. So let's understand what is this buy now, pay later space, because there have been a lot more action into this space. And the biggest not this week, but the previous week, we saw one of the big fintech acquisition of Square buying a buy now, pay later company called Afterpay for $29 billion. Not a small amount, almost $30 billion. At that point of a time, Square market cap was close to $100 billion. It jumped after that. That's different. So I think Square actually announced it here. And they got an immediate boost in their market cap after they announced their acquisition of Afterpay. So why Square willing to spend 1/3 of its then market cap to buy this? There has to be a reason. This space is growing like crazy. If you look at it now that acquisition is already almost free of cost. After announcing this, it's a Square has already gained, close to $26 billion. So when I saw that acquisition from Square, that's the point when I decided, okay, we need to dig deeper to understand what's happening in this space, what exactly is buy now, pay later, who are the players, how this industry works, what's their business model, how do they make money, because it looks like this is gonna stay here. More and more players are getting into this space. So that was a trigger for me to dig deeper into buy now, pay later. So let's talk about buy now, pay later. So what is buy now, pay later? Yeah, it's not your dad's loan. It's not credit card. But as the e-commerce market grows, a lot of startups are racing to help online retailers sell larger items to consumers. So I got to know about this one when a company called Affirm went IPO that in US. And Affirm's biggest customer was Peloton. What Peloton sells? Super expensive exercise bikes. Plus they also sell monthly subscription, but their bikes are like $2,500. So larger, I wouldn't say larger items, I would say sell expensive items to consumers with so-called buy now, pay later options. Via BNPL, consumer turn a one-time purchase into limited string of regular payments. So if I cannot afford $2,500 bike from Peloton, or say $2,400, generally they split it over 6 payments. So if I want to go and buy Peloton, they'll show me an option saying, oh, can't pay $2,400. Okay, pay $400 at 6 monthly installments. So these buy now, pay later are point of sale financing firms. Point of sale means when you're about to finish your sale. If you're in a physical store, the terminal where you swipe your credit card is called point of sale terminal. If you are shopping online, the end of your shopping cart process, the end of your purchasing process where you say, okay, pay now, that is a point of sale point. So these firms are point of sale financing firms. They work between there are 3 parties into it. One is, this is a customer who wants to buy the product. This is the BNPL service provider. And this is a retailer or merchant who is trying to sell the goods to you. So as a customer, I visit retailer website to buy the goods, and then retailer works with these service providers to finance me, to show the financing option to me as a consumer. I see some question. Home Depot and Lowe's have been doing it for purchase above $299 to pay in 6 months or more. You pay off monthly amount, and if you pay it off in time, no interest in charge. Yeah. This is exactly a similar process. Jay asks, how did these loans show up in credit report? Does it affect balance ratios? It views negatively by FICO, could be seen as a desperation move. I'll have to find out, Jay. I don't know if it shows up as a loan, but they do only a soft inquiry. So I don't think that it will show up as a loan, but I don't know. But that's a good question. That how does FICO takes this BNPL payments? Is it considered as a loan or not? By the way, more and more merchants, more and more lenders are now moving, not, I wouldn't say moving away from FICO, but they are exploring other ways to assess consumer credit worthiness than just a FICO score. And separate topic, there are companies like Upstart who are helping tons of banks in paying loans or in disbursing loans to consumers who may not have a great FICO score, but could still turn out to be great consumers. This whole issue of this FICO score is apparent among the people who haven't started their financial life in US. I was one of that person. I came to US, had a decent job, but no one will give me any loans because I don't have any credit history in US. So it's a tough time, that, hey, I make decent income. I have no loans because I manage my finances really well throughout my life. But that not having loans actually went against me. So there are companies who are working to look at your bank income statement, look at other stuff than just a FICO score. Otherwise, they are losing out on many customers who are probably, better in terms of a credit worthiness, but they don't have a FICO score. Zifty, Amazon Amazon is enticing this also multiple payments, no interest. So what's their proposition? Everyone is getting into this BNPL. So how BNPL works? Customer makes an online purchase. Merchant offers BNPL as a payment option. So there will be an option, either I can pay by credit card, debit card, or pay by a firm, pay by Afterpay, whatever service provider the merchant has signed up with. Customer will sign up if they already don't have an account. If they have an account, they will sign into their account. Product will be delivered to the customer. And the difference here is the customer actually pays directly to the BNPL. So those 6 payments that I do, I won't be doing to the retailers. I won't be giving it to merchants. I will be giving that payment to the service provider, to a firm, to Klarna, to Afterpay. So that means merchant actually gets his money at step number 3. Merchant is off the hook. Merchant's got its money at step number 3. They deliver the goods to you. Now, if you don't pay, it's merchants is not at a risk. Merchant, they receive their money from the buy now, pay later service provider. So if you sign in, if you don't have an account, so BNPL will do a KYC or whatever the credit risk assessment to see whether they should give you 0 interest, or maybe they'll charge you some interest. It's not always 0 interest. And once they approve it, merchant will ship the good, merchant will receive the money from BNPL provider, and then it is between the customer and the BNPL provider to manage the, to give the payment. So that's how the overall process flow of BNPL works. So now when we're talking about Home Depot and Lowe's, so I don't know if Home Depot and Lowe's are actually working with some BNPL providers, or does Home Depot and Lowe's actually bear the risk that customer may not deliver the payments over 6 months. So that could be a difference if they are not So Home Depot and Lowe's could still be holding the risk in their books, that instead of getting all the money up front, now they have staggered the money, staggered the payment over 6 months, but they still have all the risk on their books because they've received only 1/6 of a payment. But if they're working with a other service provider, BNPL service provider, then HD and low will got all their money. Not all their money, we'll talk about it, how much money they get, but they'll get their money upfront and rest is left between the service provider. HD and low are banked by synchrony banks. They get their money, we pay to bank. The question is, when do they get the money? Do they get the money later? So bank, again, the discussion, the difference here would be, you pay to your bank, then the bank pays to the Home Depot, or does the Home Depot gets, say if it's a $2,400, do they get $2,400 upfront when I actually make that purchase? That's the difference. So BNPL is actually integrated and into your checkout process itself. It's a seamless checkout experience. It's not that once I'm on my shopping cart at a checkout, I have to go somewhere else to do the whole BNPL stuff. If you are trying to shop something online, you see the BNPL, pay with a form right next to all the other payment options. Like you got a Apple Pay, Google Pay, PayPal, and there's a form. So it's integrated into the whole shopping experience. Let's look at various, there are multiple players. We'll talk about them, but there are multiple ways in which these players interact, the different distribution models. Some different distribution models are direct merchant supplier. These are what we know most, Affirm, Klarna, Afterpay. There are more other companies. These companies coordinate directly with the merchant. And when you're trying to shop at the merchant website, you will see their logo prominently displayed as a part of overall shopping cart experience. So these are direct merchant supplier. There are some companies that they work with Visa and MasterCard. There are some companies who work with the card issuers like Amex, Citi, Bank of America. So they offer installment solution independently during or after the checkout. So the companies that operate under the business model of credit, working with a credit card issuer, they don't charge merchants. They charge the card holders. And lastly, there are companies which actually create a technology white label solutions so that if a merchants want, instead of depending on Affirm and Klarna, merchant can build its own BNPL solutions. So for today's discussion, we're only gonna focus on this one, the direct merchant supplier. For today's discussion, we're gonna focus on this one. This is an interesting chart. Why BNPL has attracted so much have gathered so much attention over the last few years. Now, this is a chart from Australia. And in US, we started seeing, all these companies now, but in Australia, this process, this whole concept of BNPL has been there for some time. And Afterpay is actually an Australia-based company. Now they're expanding in US. So this phenomena actually started way back in Australia. And what they've noticed is a divergence between the number of credit cards in circulation and the BNPL revenue. So as number of credit cards actually going down, and the revenue of this BNPL companies actually going up, which tells us something, which tells us that consumers don't like using credit cards, but they're more comfortable to use these payment options like BNPL. So that's amazing. Which kind of corroborate another study that we had looked at 2 sessions earlier. Don't know if you had joined that, we talked about the zillennial. That was a study conducted by Bank of America Merrill Lynch on all the patterns that we see in the zillennials consumers. One of them was their payment method of choice. Baby boomers, credit cards. But if you look at Gen Z and millennials, there's a combination called zillennials. Right? So we spent almost an hour in going through the whole study. And now I am seeing some of the things that they talked about in the study. Now I can correlate why these businesses have come up, because preferences of customers have changed. Gen Z and millennials, second preferred method is phone. And so these are and I love looking at these global mega trends. These tell us what the future could be, where the consumer preferences are moving to. And if the zillennials actually prefer phone as a better payment method than credit card, there are companies which are willing to cash on it. The number of credit cards among these generations is actually going lower than what used to be between baby boomers and Gen X's. These generations don't like credit cards. So we have to find another way to get these consumers buy more. In Australia, this chart clearly shows the numbers. I don't know if there's a equivalent study done in US, because US, the BNPL is a new phenomenon, but in Australia, it's been there for many years. I see a question, so let me go through that. So in case of Amazon, etc., for example, they only have your credit card, so that is all they can hand off loan to third party like a form. How does the third party verify you? No social security number, etc. So they do run a soft check. I don't know, you'll have to go through, I've not gone through in terms of how do they run that soft check, but they do run a soft check to look at your credit worthiness and then show you the offer in terms of what you can pay later. These third parties take on the risk. Yes. The merchant like Amazon, the merchants like Peloton, they will get their payment the moment customer signs up to accept that BNPL as a payment option and goes through the process. The merchant will receive their payments from that BNPL service provider. So they take the risk of their books. What the business tailwinds? Why this is becoming bigger? Essentially, this is a digital layaway product. The industry is expected to grow 15 times to account for US $1 trillion of annual merchandising volume. That is why there is a race for fintech providers to partner or expand and claim their territory. Now, so earlier we had a firm, Afterpay, Klarna. So Afterpay, Australia-based, a firm US-based, Klarna is Europe-based company. Now, these were kind of a pure play, original OGs of BNPL, but now we got new ones, MasterCard, Stripe. We'll look at some of the others later on. A lot of these companies are jumping into BNPL space. Also, this whole trend has been fueled by lower penetration of credit cards among millennials. Oh, we already talked about it, millennials and Gen Zs. But the desire to consume, that has not gone lower. They don't have a credit, they don't like to own credit card. So my daughter, she has a credit card, but she mostly uses her debit card. So they don't want to use credit card or don't want to own credit card, but their desire to consume is still the same. And the disposable income is less. So how do you sponsor it? Well, the BNPL companies are taking advantage of this situation to provide them ways to sponsor their purchases. And in many cases, BNPL providers are giving loans as less than as like $10. No wonder that younger consumers account for 80% of BNPL transactions. Like I said at the start of this session, I'm not their customer. I'm not even their target customer. That's not me. My kid probably is squarely in eyes of BNPL service providers. 80% of revenue comes from millennials or Gen Zs. So now let's look at the business model. And I think that will probably answer some of the questions around how they make money and how does it work. So what they want to do, they want to have a fight against the overdraft fee. So if I pay by my debit card and I don't have the money in my account, bank will hit me with the overdraft fee. If I pay by my credit card and don't pay it in time, I get hit by an excessive late fee. Or if I don't have that, I go to payday lender. The interest that those payday lenders charge is through the roof. So what these companies trying to do is make it easy for consumers to purchase large value items that they cannot afford to buy right now with the money that they have in their pocket. Most of them, they do not charge consumers. But if during the soft check, they find out that your credit worthiness is a little questionable, they'll probably will charge you some interest. So it is not always 0%, but majority of the time it is 0% interest rates. And they split the value into large value into monthly manageable installments. So here's a screenshot. If I want to buy something for 1,000 and looks like if they are charging me 10%, it'll tell me this is the split. 0%, it'll give me whatever, 1,000 divided by 6. So how do they make money? So in case of a 0%, of course, there are, let's say in case of 0%, how will they make money? The money making opportunity is nothing but, it's nothing new. It's just that it's moved into the digital space, which is called factoring of account receivables. So this is how they make money. I'm a consumer. I want to buy something for $100. I can use my credit card and pay $100. That goes directly to that merchant. And then merchant pays whatever 2%, 3% fee to the credit card service provider as a merchant fee. Or I can pay cash to retailer. That's $100 go to retailers, no intermediary. I can use my debit card to pay to retailer. Or I can use BNPL and split the payment into 25. So when I do this, split the payment into 25, BNPL will pay $94 to the retailer. So what essentially happens is BNPL business, a firm, Klarna, Afterpay, they buy $100 of account receivables from merchant for $94. So a little bit an accounting term is account receivables. Account receivables means if I'm a merchant, I've sold the goods to someone, so that pending payment goes into my account receivables. Now, when the money comes into my accounts, that payment, then the account receivables goes down, the cash goes up, or the bank balance goes up. So what merchants do, the BNPL service providers do, is if there's $100 of account receivables, they'll go to merchants and say, I'll pay you $94 against this. And you get 94 upfront, your account receivables become 0. You show $6 as your expense, and your cash or your bank balance or that sort of your account, your balance sheet, that goes up. Account receivables come down. So essentially, BNPL providers, they buy the account receivables for $94. Now the other question could be, why would a retailer take a 6% cut? We'll talk about it a little later. But retailers take a 6% cut. Instead of getting all $100, they are getting $94 and they're done. I don't have to deal with customer anymore. I don't have to process that monthly payments from customer anymore. I'm done. I got 94. I balance my books. I'm out. Now it is between the customer and the BNPL service provider to manage these $25 payments. So this is one way in a BNPL makes money. They paid $94 and they'll be getting $100 from the customer. Huge chunk of the revenue comes from this factoring of account receivables. Other is late fee. They do charge late fee. If you don't pay this $25, no, late fee will kick in. Third is interest rate. Interest fee is based on the APR of loan. But the biggest portion is this factoring of account receivables. So if you really look at why this business model has become so attractive is they make $6 on investment of 94, right? So generally it's split into 6 weeks. So if we take an example of 6 weeks, so they make $6, they gave $94 to bank, and they receive $100 from a customer. $6 in 6 weeks, which means their annual rate of return is close to 55%. Isn't that amazing? I don't know why people didn't figure it out earlier. That's why this model has become so profitable. That's why Square wants to get into this. That is why PayPal is into this. That is why Stripe wants in this. That is why Apple wants to get into this. This is a hugely profitable business. You invest $94, which you give to merchant, and you have a potential to make $6 on it in 6 weeks. Better than S&P 500. Now, plus, you can charge late fee. Plus, you can charge interest rates. But even if we don't account for these two, this itself is pretty enticing. It's just a math. So that is why this space has become so interesting. But why would a retailer take a haircut? I mean, it is all based upon the fact that retailer will take a haircut and they will be able to offload $100 of account receivables to you, not to you, to BNPL service provider for $94. Why would a retailer do it? The retailer will do it because what they have seen is there's a higher conversion rate. So conversion rate is a metric that all the e-commerce retailers will track. That means how many customers have actually added the stuff in their shopping cart, have gone and actually have purchased it. How many became from a window shopper to actual customer? What was the conversion rate? What retailers have found that by adding BNPL service, the conversion rate is higher. So even if I'm losing 6% on one order, I'm able to serve more and more customers. So it's the volume has increased. So overall, my revenue has still increased after tying up with BNPL. Not only the higher conversion rate, the ticket size, the size of the shopping basket, the value of the shopping basket has also increased. which kind of makes sense, right? If I were to buy a Peloton bike for $2,400, I'll probably think twice. But if I look at them, I got to pay $400 per month. Yeah, I can afford. And I'll be more willing to buy the higher order items. I'll be willing to splurge money on the latest MacBook, whatever the latest Apple new gadget is, because I can split the payments into 6 monthly installments, and that doesn't hurt me to pay, $300 per month. But $1,800 going out in one time, that does make a big difference. So the merchants have seen that there is higher conversion rate as well as higher average order values, and merchants are reporting increase in volume and revenue after introducing BNPL in the overall purchasing process. That is why everyone wants in. So the players, there are multiple players in this. The traditional players, Afterpay, Affirm, Klarna, PayPal introduced their BNPL related service. There is QuadPay. Then the other model wherein the card networks are trying to offer kind of similar service. So multiple customers. Multiple players in this space, and a lot of VC money is also going into this. Again, Alma raised some money, ScalaPay, Wisetack, Zilch, Divideo, Klarna raised recently money at a valuation of $46.5 billion in June. So now Square is looking at Klarna's valuation in a private market is 45.6 billion, and Square got Afterpay for 30. Oh, it's a deal. Let's do it. It's cheap. Because in a private markets, the companies, competitors like Klarna, again, I know you can't make direct comparison because I don't know the numbers of Klarna versus Afterpay. No one knows it because those are not public companies. But again, sentiment perspective, gosh, these valuations are going higher and higher. Let's grab it at $30 billion, $29 billion. So not only these players, not only the fintech companies are into this, tech companies are going into this. So Apple will be launching its BNPL service with Goldman Sachs. So Goldman Sachs is a partner for Apple credit card. So Apple already announced that they will launch their own BNPL service working with Goldman Sachs. But after the Square announced acquisition of Afterpay, too many afters in this sentence, but let it be. After Square announced its acquisition of Afterpay, Apple announced that they will start BNPL for Canadian customers in a week. So I think August 11th was the date, or August 12th. So anyone from Canada, if you go to Apple website and try to buy something in Canada, you may be able to see a BNPL service with Affirm. So they immediately came out after Square announced. Apple came out saying for Canadian customers, we'll offer BNPL services tying up with Affirm. And again, my perspective is Apple is trying to test. Oh, see some background noise. So let me mute everyone. Okay. So my thought process is Apple is now trying to, dip toes in this, trying to figure out how these things work before they launch their big one, which they already announced. So big players are in it. Okay. So that's why this has become such a hot space. I mean, when I look at these numbers, I was like, ooh, that makes sense. Now this makes sense. Now this makes sense why these companies are commanding such a higher valuation. Okay. So let's dig deeper into Square by selling 25% of its market cap to snag Afterpay. It was a $29 billion deal It was an all stock deal. So now that it has become more expensive because it was an all stock deal. But the shares of both Afterpay and Square were up, which is generally not how you see. So generally in the acquisition space, the acquirer has to pay higher than what market wants. And most of the time you'll see the target goes higher, where the acquirer goes lower. But in this case, Afterpay and Square, we saw both of them, they went higher. The shares of both Afterpay and Square were up after they announced this. So what Afterpay brings to Square? So they had a big investor presentation. We'll not go through all, but maybe just look at, they are looking at overall $10 trillion of online payments, and BNPL penetration is only 2 trillion. Oh, there was one chart which says how they'll reinforce. Afterpay growth has been 105%. Revenue has been up 92%. Yes, Square and Afterpay, a strategic combination. Shared focus on empowering merchants and consumers. Square has a similar product. Last week we looked at Square earnings. Similar product, they're focused on consumers as well as merchants, Cash Apps, and their Square. Afterpay builds connection between the seller app and the Cash App. So if I'm using Cash App and I'm trying to buy something from seller, Afterpay will provide a glue for me as a consumer, as a customer of Cash App, to split the payments into those monthly payments. So that's why now Square wants it. What Square will do, it will integrate Afterpay into their seller app. So when I go to the seller app, you can say, continue with Afterpay. And Afterpay also integrates in your Cash App, means Afterpay consumers will be able to manage their installments and repayments directly within the Cash App. More importantly, to pay this money through the Cash App, how the consumers will pay that money? They'll have to move money into Cash App. Means that I don't know if they mentioned it here or not, but means the asset under management in the Cash App will grow higher. Square is thinking a little longer term, right? There are a lot of benefits that Square is thinking that we can get by integrating the Cash App and the seller's app through this Afterpay. And that also brings in, under another 100K merchants that currently are customers of Afterpay. They can easily integrate, bring them all to Square platform. That's why Square wants to do this. Okay, financial numbers we can talk later, but the business logic is that. Is it a costly affair? Yes. Klarna's market cap is 33 times of revenue. Affirm is 17 times of revenue. Square is paying 42 multiples on the revenue. But why Square wants Afterpay? It brings global revenue. Afterpay is more focused on Australia, outside of US, where Square can get a good foothold. So it brings global revenue, global users, diverse merchant network, right, outside of US. For Square to grow on those additional geographies, Square would have to spend to drive those assets in those geographies on their own. So Square is saying, you know what, I'm willing to pay up a little extra and get these users, these merchants, which provide some diversification to overall Square seller ecosystem. And Square knows that Afterpay will not get cheaper in time. It was considering US listing, which means They would have got more resources, could have become more expensive. So what Square wanted to do, they had choice, only two choices: buy now, pay a lot, or buy later and pay more. Isn't that interesting? So for an afterpay, that's the choice that Square had. Either buy now and pay 42 times revenue, which is a lot, or you buy later and you have to pay even more. So Square spent a bunch of its equity. The shares have gone up from $52 to $264. That is why they didn't use the cash, because our shares have gone up. Let's use that equity, put it to some good use, get some more geographic footprint, accelerate our profit growth. And, we don't have to build a product on our own. Let's snag afterpay. So that's the story of pay now, buy now, pay lot, or buy later, pay more. So what they decided is buy now, pay lot. So while now, hopefully I've got you excited over BNPL from an investor perspective, from a merchant perspective, now I want to go towards the dark side of BNPL. So I said, this is not for me. When I look at the dark side of BNPL, that makes me think twice of where we will be taking our next generation. So I want to explore that, but let me look at some questions. Ramesh, very good analysis. Thank you. Glad that you liked it. I guess since I paid off all these loans in 6 months, instead of paying high interest fee to credit card company after the statement, it was a great deal for me. Yes, for consumer, if you are not being charged for a late fee, it's great stuff for you. But not all consumers are as diligent, Ramesh, as you are. So for example, for me, I'm happy with the credit cards, but probably my credit card provider doesn't want me as a consumer because I haven't paid a penny in more than a decade in late fee charges. I always pay upfront. I always pay in full every month. So ever since I've been holding credit card for now almost 2 decades. I mean, in US, not 2 decades, but outside US, I've been holding credit cards and never paid any penny. So if you are diligent, pay up in time, great option for consumers. It was a great deal for me. Looks like retailers lose, but like you said, they will increase their sell. So now we will look at in terms of what is the impact on the retailers. So till now, retailers all have reported increase in the sales after they added BNPL. So even though they are losing some percentage on every order, they've been able to increase the number of orders, or they're able to increase the value of that order. That overall revenue has still grown, right? Plus a repeat customer. Now I buy appliances, mowers, everything at BNPL. Yeah, stickiness. But let's go back and look on the dark side. If you are not such a diligent customer, right? If you're not, once you have done with this, it's great. You got a stuff at home, but we got to pay. And if you're not paying diligently, what are the impacts that we are seeing because of BNPL? The negative impacts of BNPL. Till now, we looked at all the advantages. US, we don't even have a history to start talking about the negative impacts, but we do have something from Australia. So I was able to get a study of the whole study of the BNPL, mostly on the dark side, from Australia, a think tank group in Australia. So I'll share some high level items from there. But this is general one. This is not from us. So the charts you see will be from Australia, but this is, again, how we look at it is retailers' cost of accepting payments. So cash is cheapest. You pay me cash, I don't have to pay any merchant fee to anyone as a retailer. It's the cheapest form for me to accept cash. I mean, The cost is, let's say, 0.5% because there is a labor cost involved. Then someone need to take that cash and deposit it in the bank. Sometimes I may get counterfeit bills. Sometimes that bills could get damaged, could be flooding. So overall, on an average, say the cost to the retailer of accepting cash is 0.5%. Debit card is also low, 0.5%. Credit card, it is higher, 3% or higher. I hate, for our small business, I hate when customers actually pay via credit cards. But they demand credit cards. So initially when we started the business, we only allowed paying through bank. But then we saw a lot of customers demanding credit cards. So we initiated credit card payments as well. And boom, on my P&L statement, the fee, the line item against the fee charged by banks or that has just shot up, because for every credit card payment that we receive, we got to pay 3% or higher to the payment processors. Like I worked through Intuit. But something that we talked about last time, higher the credit card rewards, higher the fee that those cards charge for merchants. Those great credit card rewards that we see from Amex, Platinum cards, those are all the benefits that those rich customers enjoy. All those are actually being charged back to the merchants. Merchants also increase the base price of goods to compensate for the higher fee. And those seem counterintuitive, but then if they increase the base price of the goods, everyone has to pay that base price. So the lower income groups, which is what the majority of the customers are, not the super rich who have got those fancy rewards cards. Majority of the customers are middle income group, lower income group people. And we end up sponsoring those rich reward programs, because if the merchant wants to accept those American Express cards, they have to pay way higher, and they increase the price of goods to compensate for that. Right? Now, if BNPL starts to charge 6%, we don't see that money going directly from our front pocket. What we could see is the retailers could start to increase the prices of the goods for everyone else, like what they've done with the credit cards. As credit card became more and more popular, as more and more rewarding credit cards came into picture, merchants start to increase the prices of their services or their goods to compensate for the higher fee. I won't hold it against merchants. We had the similar discussion in our business that maybe next year we raise the base prices of everyone, because now we are paying too much in the fee to Intuit, right? So if 6%, today everything is okay. US, we haven't seen this happening yet. But if the history tells us anything, we should see all these 6% charges that AR discounting reflecting through the back door in the base price increase of the products. So some BNPLs have started to offer rewards. So it's becoming worse. So the ideal way to pay for someone like me is save now and pay later. I don't want to use BNPL surveys. I'll probably save now, and once I have money in my account, I'll pay later and buy the goods later, right? So this is generally, what we have seen in history. Once the credit card came into picture, we saw increase in prices. It resulted in increases prices for everyone. Similar thing BNPL will do. Second thing, the delinquency rate for all consumer loans is 2 to 3%. When I say consumer loans, means everything, not just BNPL, include credit cards, include or any other type of unsecured consumer loans. That's the delinquency rate. Now this is from Australia. Charge off and delinquency rates, right? If you look at it, everything is around close to 2% is for 2 to 3%, right? Credit cards 2.88, 2.62, 3.51, 3.76. Okay, 2 to 4%. Here's a Australian Securities and Investment Commission report. 21% of the buy now pay later users actually missed a payment in 12 months. 21% is a delinquency rate in BNPL segment. And it is easy. You think, oh, I'll have to pay those 4 rates, I'll pay it later. But we are seeing that in Australia, they looked at 21% is a delinquency rate, which is way higher than the general consumer loans, right? 1.54 all the way to 2.32. That means a lot of money comes into, from a consumer perspective, it hits you in the long term. Again, if you're not diligent about your finances. Some outcomes for buy now and pay later users. Again, the study from Australian Securities and Investment Commission report. Now, these charts I pulled up from that report. What those consumers say is, after we bought Peloton and all that, consumers who had one buy now pay later agreement, I have to taken out additional loan to make my buy now pay later repayment on time. So 20% of the consumers, 20% of those consumers who had 3 buy now pay later. I went to Peloton, I can't afford it now. I went through BNPL. Yeah, I'll have to pay only $400. Great. Well, I want that MacBook. Can't afford it now. It costs $1,800. I have to pay $300. Okay, got that BNPL arrangement. And then I went for an expensive vacation to Hawaii. Can't afford it now, but I can have to pay $800 per month. Went through BNPL. Consumers who have got 3 BNPL arrangements, 20% of those consumers told that they have to take an additional loan to make the BNPL payments repayment on time. 25% told I had to cut back or go without essentials in order to make my BNPL repayment on time. That's the dark side. This is reality. Look at another one. Percentage of credit card accounts that incurred a monthly interest charge from October 2018 to April 2019. BNPL credit card users, and these are the normal credit card users. The BNPL credit card users means the users who have BNPLs, as well as you also use credit card for other purchases. They, on an average, 26% more customers had their monthly charge on their credit cards, because now they have to figure out whether should I pay off my credit card or should I pay to my BNPL. Again, I think that the overall psychology here is because the upfront payment is so low, the consumers kind of forget in terms of how many payments that they are getting themselves into. 70%, 25%, 26% difference. Another one. And this looks like, was it done in America? Yeah, this was done in America in July 2020 and March 2021. How likely are you to make a late payment on a buy now, pay later plan in next 12 months? So that service shows Very likely means almost 20% in 2021 says it's very likely that they are able, there'll be late payment. Almost a third of buy now pay later users have made a late payment on BNPL program. We asked respondents how likely they are to make a late payment next year. The change is very worrisome. So last year, 2020, this is a new industry in US. Only 7% told that very likely they'll have to pay a late payment. 2021, March, almost 20% told that they'll have to pay a late payment fee on their BNPL. This is American chart based on American consumers. That's worrisome. So while this is great for retailers, great for service providers, but consumers are consumers. We are not diligent enough. Average consumer, I'm not talking about the ones which are here. You probably are very diligent about the finances. That is why you come here and we talk about finances, but not average consumer is like that. They end up tying into so many BNPL loans because each one is so cheap, or each one's a ticket value, upfront ticket value so small that they end up taking into so many loans that it becomes unsustainable for them. So that's the dark side of BNPL. So I'm not target consumer. I don't want to be, but looks like make hay while the sun shines. That's what Square wants to do. That's what every other company wants to do. But eventually, I guess we'll end up again into the same issues of the next two generations will start hating BNPL. Like the current Gen Zs hate credit cards because they have seen their parents getting buried under credit card debts. The Gen Zs kids probably will hate BNPLs because they would have seen their parents' financial ruins because they got so many BNPL arrangements that they were not able to pay all them in time. Again, to me, it looks like same wine in a different bottle. If you don't want to use credit card, financial services firm will find another way to entice you into buying something that you can't afford to buy anyway. So my opinion, best is, why don't you save that money and while you can, once you afford it, then buy it. Save now, buy later. That's what I would want to do. But do I want to profit from this current trend? Sure. I'm okay holding my Square shares. Ramesh says, okay. Samuel says, I hate here in Greater China plus Hong Kong, try to use cash so I know how much I spend. Here I'm forced to use credit card. Yeah, essentially, even the same is the case here. Now I'm looking at it that my monthly expense has gone high because I don't even realize when you swipe your credit card, whether you're swiping it for $50 or $100, the difference in the pain you feel is negligible. But if you have to pay through your cash, the physical money, the physical bills going out of your hands is cause a different impact. So yeah, I'm with you, Samuel. But that's the world we live in. Ramesh says, wow, did not realize that merchant pays higher pay to credit card and we all pay higher cost. Oh yeah, that's a fact of life. So we are already have decided to increase the rates in our small business because we introduced credit cards from this year and we got hit by, because customers were asking for it. So okay, we'll add, but we'll increase the fee. I live by the rule, don't buy if you can't pay at the end of a month. Yeah, exactly. Rossi, modern day slavery. I mean, the slavery is what we bring upon ourselves, right? I don't want to blame. Again, I'm not against all these companies. These companies are doing it because we as a consumers, not we, but over a general population, consumers will want it. Most of the consumers They want the things that they cannot afford, and then the companies will find a ways to give those to you. Same wine, yeah, Zifty, very true, good insight. Same wine, different bottle, exactly. Right now, everyone is going towards BNPL. Maybe a few years down the line, we will see a lot more, defaults happening on BNPL. Consumers getting disenchanted with this. That time we'll see what happens to all these companies. Asif says merchants should provide pay now discount like the gas station instead of pushing the cost of delinquency to customers, which is the risk these finance companies are taking up. Yeah, so Asif, I agree with you. And some merchants, they do provide cash discount, but please understand that means an additional overhead on the merchants for them to have additional different step for their customers. As long as if merchants see that by increasing the base rate for everyone, if the consumers have started to leave them, probably they'll add discount. But if not, they'll start with by increasing 2%, 5%. And the majority of the customers, they'll just suck it up. They'll just suck it up. And because there's a convenience also of payment. What happened to choice and freedom? True. With the shopping moving more and more to online, you don't even have an ability to pay cash. So this whole cash discount is only applicable on the physical retail storefront. And most of the retailers, why to get another, the handling of cash? It's also a security problem of transferring a cash and all that. Cash is something which a dishonest employee could steal. All that cost gets involved. So the easiest is, okay, let's increase the rate for everyone. Take an easy way out. And we end up sponsoring those fancy rewards for all, those super ultra rich consumers, because they force the merchants to increase the rates for everyone. All right, so that's a overall analysis of BNPL industry growing like crazy right now. But we'll have to see what happens in US based on what we have seen happen in Australia. But I guess this will still continue to grow for some time. Zifty says, use credit cards for different purposes. For bookkeeping of expenses, save me a lot of time. I get annual reports, sort, analyze my spending, etc. This is invaluable. Because every other aspect of life has moved electronic. If the payment move into some form of electronic payments, it makes our life so much easier. There are some customers who pay cash to us, and I hate that. Because that means for us as a business owner, I have to physically account for cash receipt and then tally it with the invoice and all that. If they pay through credit card through Intuit, boom, everything is all tied together. It will automatically settle against that invoice. I don't have to do those things manually. Right? So as a merchant, I understand why these electronic form of payments are good. But I hate Intuit. They increase the rate of ACH also. Gosh, I have to find a new provider for accepting payments. Ross, does not have to be physical cash. Direct debit through Zelle can also be implemented. Yeah. I have seen the usage of Zelle. Again, when I say I have seen, means I'm talking about our other small business, which is owned, my wife runs mostly. I just do a business manager work. So a lot of customers, they're actually are willing to pay through, more willing to pay through Zelle. But Intuit doesn't directly integrate with Zelle yet. So I still hate because we have to do a manual step to get into our accounting. All right, guess that's it on BNPL. Oh, we'll have to skip the option trades review today. But I can hang around for another 5-10 minutes for any other questions. Any other stock questions? What opened my eyes was this BNPL Australian study. I think this is the one. Yeah, Australian Securities and Investment Commission. So this is a very 31-page long study. So I showed you some of the big numbers, kind of a summary from this study. Doesn't look good to me. You welcomed Morris. So for BNPL stocks, which symbols would you play with options? So currently, if you look at a BNPL, for us as an investors, oops, please. So let's look at the player. So AFTPY, Afterpay. I don't think it won't even show up on my FinViz. Afterpay. So Afterpay is anyway going will be bought over by Square. So I would play with Square rather than playing on Afterpay because again, way more diversified platform. The other one is PayPal. PayPal also have their BNPL offering. Affirm, if you want pure play BNPL, I think for now, Affirm is the one which is pure play BNPL. But understand look into the recent earnings of Affirm, because when we did a pre-IPO analysis of Affirm, my biggest concern on Affirm was their huge dependency on Peloton. So that was the biggest risk. So we did a review of S1. Maybe I should add a date on which we done this. Oh yeah. So we did around November last year. So the biggest risk was customer concentration. I won't touch any company in which the 30% of revenue is coming from one customer. So if a firm, after that, I have not looked into a firm in the recent earnings in terms of what their customer concentration is now. But if that has come down, a firm could be a play for, this is a pure play in BNPL segment. I think these are the only public market plays. But then PayPal is there, Square is there, Apple is going to get into it. But those have a lot of other businesses other than just BNPL. And Affirm is also optionable. So you can do options on Affirm. Ramesh, great review. Thank you. You're welcome, Ramesh. Same thing. Welcome, Bob. Asif, great analysis. Thank you. You're welcome, Asif. Welcome, Zifty. So Affirm, if you want to play in BNPL. Cool. But I generally, rather than being focused only on BNPL, I have positions on Square and PayPal. The reason was not BNPL, but those are going to be the financial powerhouse of the future. And addition of BNPL makes them even more attractive. All right, no other questions? It's like we're done for today. Cool. Thank you everyone for your time. More. You're welcome, Liz. Samuel Moore, what? I will take one last question from Samuel. Okay, yeah, if you have a question, that's fine. Are we going? No, okay, yeah, I can stay on for 5 minutes. I never understood Zelle. Banks already have their bank debit card. So what is Zelle offering? So again, I think Zelle, it was an answer from banks to pay as against the PayPal. I don't want to use my debit card, etc. for payments, debit cards or credit cards. But it's way easier, and I don't want to share my, let's say, account number with anyone else. Zelle makes it way easier for us to pay to someone with just an email ID. And that's what the PayPal started with, right? Why share your account numbers with others to get any ACH payments? Just pay to an email ID. So I think that's where the Zelle started from. And the consortium of banks, it's not one company, it's the consortium of banks. They got together and say, how do we offer a competitive product so that the customers can pay directly through our banks to banks rather than paying the merchants through PayPal. So I do see that value in Zelle because of that. Zelle offers platform P2P, but the same platform can be used for merchant payments without disclosing account details. I mean, not just P2P. For example, the account that I have actually 2 accounts with Bank of America. Not I. Yeah, but I have my own personal bank account, personal account with Bank of America. And then we have a business account with Bank of America. And Zelle is the option in both. So for the customers, so I gave them, okay, pay to this email ID, which is email ID tied to our business account, which is a business email ID. If someone wants to pay me as a person, I'll just give them my own personal email ID, which is tied to my personal account. So, customers pay us directly through my business email ID. That's where we receive a lot of Zelle payments. From Ross, same like in Asia, folks use QR code to pay, come straight from user account. Yeah, the QR code is amazing. I mean, the whole in India, you see, they recently received a huge big funding. Now that name won't come to me. And then Alipay, they all use QR code. Unfortunately, in US, we are behind the technology. Asia is a lot big on QR codes, which is so convenient and much better way to pay using just the QR code. Paytm, thank you, Ross. Yeah, Paytm. It's been some time since I visited India, but we're trying to go home, visit family next year. But what I see is even those, street roadside vendors who just have a wooden, push cart. All they need to accept the payment, what they have done is they have a printout, laminated printout. They have stuck on their wooden, the push cart, which says all they have is a QR code on that. No other, credit card terminal, nothing else. Either you pay cash or you just pay to that QR code. That's amazing. And a lot of what I heard is almost all, these all street vendors, they just use that Paytm and pay through QR code. Paytm recently enjoyed huge valuations. They got investment, I think, from not SoftBank. They have a tie with Alipay, if I recall correctly. Does anyone know the cheapest payroll service provider for very small business, 2 to 3 employees? I don't know. So the way I work with Jay is, so we have only 1 employee, which is my wife. On our small business, I work with my CPA, and because it's only, my wife is the only listed employee on that business, we only do a quarterly payment, and he charges me $50 to do the quarterly payments. We don't get monthly pays. But that may not work if you have other employees other than your spouse. And if you want, maybe ping me separately and I can tell you who is my CPA who does that. Ross says, me thinks this bank's capitalistic actions to not use direct pay. How else will they screw users for interest payments? I mean, banks, they do offer Zelle. So there is, okay, you're maybe talking to direct P2P. Cool, guys, I gotta go. We gotta go to drive all the way from Cupertino to Mountain House today. So looking for some long drive today to meet some friends. So let's call it a day here. And I gotta prepare for that one. Thank you everyone for your time. And let's talk again next week. Or if you're not attending crypto, otherwise if you're attending crypto session, we'll be talking on Thursday evening. A lot of action in that front also. Good day and have a very profitable week next week. Thank you. Thanks, Zifty. Yeah, it'll take an hour at least to go to Mountain House. Hopefully, because this is a weekend, hopefully no traffic. Bye-bye, everyone.